Welcome to the Masterclass on Business Credit Card Stacking for the year 2026, where we will break down exactly how to secure over $50,000 in 0% interest funding without giving up a single percentage of equity in your company. This strategy is the secret weapon of savvy entrepreneurs who need access to capital for inventory, marketing, or expansion, but do not want to deal with the slow and painful process of traditional bank loans or the high costs of venture capital. Credit card stacking is essentially the art of applying for multiple business credit cards from different banks in a very specific sequence to maximize your total credit limit while minimizing the negative impact on your personal credit score. The goal is to get approved for 3 to 5 high-limit cards within a short window, often accumulating $50,000 to $100,000 in total available credit that you can use at 0% interest for 12 to 8 months. Before we dive into the specific banks and the application sequence, you must understand the prerequisites, because if your foundation is weak, this strategy will fail. First and foremost, your personal credit profile must be strong, because even though we are applying for business cards, the banks will almost always perform a personal guarantee check. This means you need a personal credit score of at least 720, although 740 is ideal to ensure the highest starting limits. Equally important is your credit utilization ratio on your personal cards, which must be under 10%. If you have maxed out personal cards, you look risky to lenders and they will deny your business applications. You also need to ensure you have no derogatory marks, no late payments, and ideally less than 2 hard inquiries on your report in the last 6 months. Once your personal credit is polished, you need to have a legitimate business entity set up. While you can technically apply as a sole proprietor using your social security number, having a filed limited liability company and an employer identification number makes you look like a serious business and helps separate your finances. You should also have a professional business address and a dedicated business phone number listed in the Nashville 411 directory, as these are data points that underwriting systems automatically check to verify your legitimacy. Now let us get into the core strategy of stacking. The reason we stack applications is to beat the bank's algorithms that detect recent inquiries. When you apply for a card, a hard inquiry is placed on your credit report. If you apply for one card, wait a month, and then apply for another, the second bank will see the inquiry from the first bank and might get nervous that you are seeking too much credit. However, if you apply for multiple cards on the same day or within a very tight time frame, the new inquiries often do not show up immediately on every bureau, or the banks do not have time to react to the other applications happening simultaneously. This allows you to get approved from multiple cards before the window closes. The sequence of applications is critical because different banks have different rules. In 2026, the golden rule is still to start with Chase. They have a strict rule known as 524, which means they will automatically deny you if you have opened 5 or more personal credit cards in the last 24 months, because business cards from most issuers do not count towards this limit. You must apply for Chase cards first while you are still under that threshold. Chase offers some of the best 0% interest business cards in the market, with high limits and valuable rewards points, so you want to secure at least 1 or 2 of their cards at the beginning of your stack. After you have secured your position with Chase, you should move on to American Express. Amex is unique because once you are already a customer with them, they often do not perform a hard pull for new card applications, instead using a soft pull to approve you based on your existing relationship. This is a massive advantage in stacking because it allows you to add significant funding without damaging your credit score or showing more inquiries to other banks. You can Often pick up a business charge card for high spend volume and a traditional business credit card for carrying a balance. The next layer of your stack involves banks that are sensitive to the number of inquiries you have, so you need to hit them before your report gets too cluttered. Institutions like US Bank and Bank of America are excellent targets here. Bank of America specifically is known for being generous with limits if you have a banking relationship with them, so opening a business checking account with them a few weeks before your expiry can significantly boost your approval odds. Another crucial component of the 2026 strategy is leveraging regional banks and credit unions. Many people ignore them, but they are often hungry for business clients and have more flexible underwriting standards than the big national banks. Institutions like Navy Federal, if you are eligible, or other large credit unions can offer massive limits with low interest rates. When you are executing the applications, it is often best to prepare all your applications in different browser tabs and submit them as close together as possible. This is to ensure that when the automated systems pull your credit report, they see the cleanest possible version of your history. However, you must be aware of which credit bureau each bank pulls from. For example, if you know that Chase pulls Experian in your state and Barclays pulls TransUnion, you can apply for both without them seeing each other's inquiries. This requires researching which bureau is favored by which bank in your specific geographic location, usually found on credit forums and databases. Once the approvals start rolling in, do not be discouraged if you get a pending decision or a denial. This is where the reconsideration line comes into play. Never take the first no as the final answer. Call the bank's reconsideration department and speak to a human underwriter. Explain that your business is growing and you need the capital to purchase inventory to fulfill upcoming orders. Often a human can overturn an automated denial if you can provide a logical explanation for your recent inquiries or verify your business details. Now that you have secured $50,000 or more in credit limits, the question is how to use it effectively. The power of this strategy lies in the 0% introductory APR periods, which typically last for 12 months. This effectively gives you an interest-free loan. You can use this capital to buy bulk inventory at a discount, pay for a massive advertising campaign to acquire customers, or cover operational costs while you wait for receivables. The key is to ensure you have a plan to pay off the balances before the 0% period ends, because the interest rates will skyrocket afterwards. Another advanced tactic in 2026 is using services that allow you to pay vendors who do not accept credit cards. Platforms like Melia or Plastic allow you to charge your card, and they send a check or wire to your supplier. This allows you to use your credit line for almost any business expense, including rent or contractors, maximizing your cash flow flexibility. You must also be disciplined with your minimum spend requirements. Most of these cards come with sign-up bonuses that require you to spend a certain amount, like $3,000 or $5,000 in the first 3 months. These bonuses can add up to thousands of dollars in cash back or travel points, which essentially reduces your cost of funding even further. Do not open more cards than you can handle. The minimum